The year 2025 began with a sense of optimism and renewed energy for North America's auto industry. Automakers were ramping up production, new models were rolling off the lines, and cross-border trade was humming along smoothly. Executives and workers alike were hopeful that the worst of the previous decade's disruptions were behind them, and that the industry was poised for a new era of growth and innovation. But that optimism was shattered in February, when the Trump administration stunned the industry by announcing sweeping new tariffs on vehicles and auto parts imported from Mexico and Canada. The announcement sent shockwaves through boardrooms and factory floors across the continent. The 25% tariffs upended decades of carefully built cross-border manufacturing. What had been seamless, just-in-time supply chains suddenly became logistical nightmares. Parts shipments were delayed or stranded at borders, and assembly lines ground to a halt as companies scrambled to adapt. Suddenly, vehicles like pickup trucks assembled in Mexico and minivans built in Canada became far more expensive to import into the U.S. Showroom prices soared almost overnight, leaving both dealers and customers in shock. Automakers faced a stark and immediate choice: absorb massive new costs and risk their bottom lines, pass those costs on to consumers and risk losing sales, or consider the daunting prospect of relocating factories, a process that would take years, cost billions, and disrupt thousands of lives. The industry's reaction was swift and filled with alarm. Business groups and unions alike warned of widespread job losses, higher prices for American families, and a ripple effect that could devastate communities dependent on auto manufacturing. Many argued that using autos as a bargaining chip in trade disputes would ultimately hurt American workers the most. The tariffs weren't just a tax on foreign companies, they threatened the entire North American auto ecosystem. Decades of integration between US, Canadian, and Mexican factories were suddenly at risk, with every link in the supply chain feeling the strain. As the first quarter of 2025 closed, the industry braced for a crisis with no clear end in sight. Uncertainty loomed over every decision, and the future of North American auto manufacturing had never felt more precarious. For General Motors, the sudden imposition of tariffs triggered a massive $5 billion dilemma, one that would shake the very core of the company's global operations and future strategy. GM's highly integrated North American network meant that 750,000 vehicles assembled in Canada and Mexico now faced a staggering 25% cost hike, instantly making them far more expensive to produce and sell in the US market. This price shock threatened the competitiveness of GM's core products, including bestsellers like the Silverado pickup and the new Equinox EV, both crucial to the company's bottom line and reputation. The financial hit didn't just jeopardize quarterly profits, it put future investments, research and development, and thousands of jobs at risk, sending shockwaves through the entire company and its workforce. GM was forced to consider drastic options: shutting down plants abroad, relocating production to the US, or absorbing massive losses, none of which offered a clear or easy solution. Relocating factories would cost billions of dollars and take years to complete, all while the company faced the uncertainty of whether these tariffs would even remain in place long-term. If GM chose to do nothing, it risked losing precious market share to competitors who were less exposed to the tariffs, potentially eroding decades of hard-won brand loyalty and sales leadership. The company found itself cornered. Every possible move carried enormous risks, and the pressure on leadership was immense as they weighed the fate of the company. Suddenly, the very foundation of GM's business model, built on cross-border efficiency and scale, was in question, leaving analysts and executives scrambling for answers. The tariffs weren't just a policy shift, they represented an existential threat to GM's future, casting a shadow of uncertainty over every aspect of the business. For General Motors, the stakes had never been higher, and the next move could determine the company's fate for years to come. GM's leadership responded with rare candor. CFO Paul Jacobson warned investors that permanent tariffs could force GM to consider relocating manufacturing, a move fraught with risk if political winds shifted. GM's initial strategy was defensive rush vehicles into the US before tariffs hit and reduce foreign inventory. Unlike rivals, GM avoided immediate shutdowns, instead ramping up US production where possible. The company hoped the tariffs would be temporary, buying time without making irreversible decisions. Behind the scenes, frustration ran deep. Years of investment in an integrated supply chain were suddenly at risk. GM's public message was clear: the tariffs threatened not just profits, but the company's entire future. The warning to policymakers was unmistakable. Detroit's big three automakers, Ford, General Motors and Stellantis, faced a crisis that would test their resilience and reveal their true character. As the shockwaves of new tariffs rippled through the industry, each company charted a sharply different course, exposing deep contrasts in their strategies and philosophies. Stellantis responded with the most drastic measures, taking a hardline approach by idling major plants in both Canada and Mexico. The company laid off thousands of workers almost overnight, a move that sent a clear message about the immediate financial pain caused by the tariffs. For many employees and their families, the impact was devastating, and the ripple effects were felt in communities dependent on these jobs. Ford, in stark contrast, chose to keep its assembly lines running at full speed. Rather than cut production, Ford doubled down on its American identity, launching a bold "From America for America" sales campaign. The company offered deep discounts to clear out inventory before prices could rise, hoping to win over patriotic buyers and keep its workforce employed. Stellantis's sudden shutdown sent shockwaves through the entire auto industry, raising fears of a domino effect. Meanwhile, Ford's gamble was risky, betting that aggressive marketing and patience could help them weather the storm without resorting to layoffs. General Motors found itself caught in the middle. GM managed to avoid immediate shutdowns, but the company's leadership issued stark warnings about the long-term consequences if the tariffs continued. Executives spoke publicly about the uncertainty ahead, and employees braced for possible changes. The contrast between the three automakers was striking. Stellantis slashed production, Ford slashed prices, and GM tried to buy time, hoping for a resolution. Each company's response revealed not just their vulnerabilities, but also their core beliefs about how to survive a crisis. Boardrooms buzzed with debate, analysts scrambled to predict the fallout, and workers wondered what the future would hold. The crisis forced every automaker to rethink its future, pushing them to innovate, adapt, and reconsider what it would take to stay competitive in a rapidly changing world. Under mounting pressure, the unity of the industry began to fracture as each company's divergent path revealed the true cost of crisis and the uncertain road ahead. The tariffs put auto workers' livelihoods at risk across North America. UAW President Shawn Fain supported protecting U.S. jobs but condemned the tariffs as a blunt tool that hurt workers in all three countries. He called for smarter trade policies, not disruptive taxes that punished the wrong people. In Canada, Unifor's Lana Payne blasted the tariffs as reckless, warning of immediate layoffs and highlighting the industry's cross-border integration. Both unions stressed that a shutdown in one country rippled across the continent, costing jobs everywhere. Workers became collateral damage in a political fight they didn't start. The message from labor was clear: protect jobs with smart policy, not trade wars. The North American auto industry is a single, integrated machine. Engines from Mexico, transmissions from the US, final assembly in Canada. Trade agreements made this possible, allowing automakers to optimize for efficiency, not borders. The 25% tariff shattered this system, adding costs and complexity at every step. Parts and vehicles crossed borders multiple times. Now, every crossing risked a new tax. The result: bottlenecks, delays, and rising expenses that threatened the entire supply chain. A shutdown in Canada meant lost orders for U.S. suppliers. A tariff on a Mexican-built truck hurt American parts makers too. The industry wasn't built for walls, it was built for open borders. The tariffs threatened to break the engine of North American manufacturing. The real victims of the tariff war were workers and consumers. Thousands lost paychecks as plants idled in Canada, Mexico, and the U.S., the first casualties of a trade fight far removed from the factory floor. For American families, the tariffs meant higher prices. New cars suddenly cost thousands more, putting them out of reach for many. Dealerships saw a brief sales rush, then a sharp slowdown as sticker shock set in. The lesson: in a deeply connected economy, trade barriers backfire, hurting the very people they're meant to protect. The GM tariff crisis became a case study in unintended consequences. In North American manufacturing, there are no easy wins in a trade war. In the end, everyone pays the price.